Welcome to this explainer on the expenditure method. I'm Economist A. And I'm Economist B. Today, we're basically acting as your macroeconomic detectives. We're going to track exactly how money circulates through our entire system. Exactly. Get ready, because we're looking at the economy through a very specific lens based on one absolutely crucial principle. One person's spending is always another person's income. Let's dive right in.
So here's our economic roadmap for this explainer. First, we'll meet the outlay method.
Then we're looking at everyday household spending, followed by business investment expenditure.
Next up is government and global trade, pulling it all together in the final equation, and finally, some crucial measurement precautions.
Section 1. Meet the outlay method, or as we like to call it, tracking the receipts.
You know, often when people calculate national income, they just add up earnings, wages, rent, profits, the whole shebang. But we're flipping the script completely.
Right. Instead of tracking what people make, we're looking purely at what they spend. The outlay method calculates national income by summing up literally all the consumption and investment expenditure made by individuals, firms, and the government in a given year.
So this incredibly elegant approach just captures all the money spent on consumer and capital goods. Basically, if a final product was bought in the economy this year, we're counting the cash spent to get it.
And man, this perfectly illustrates the sheer scale we're dealing with. Just look at this interconnected web. You've got households, agriculture, massive trade ships, trains, stock markets, all churning together.
It's like a giant puzzle. The currency flows continuously between all these diverse sectors. So the outlay method basically attempts to cast a giant net over this entire ecosystem, capturing the money as it changes hands to purchase those final goods and services.
Moving right along to Section 2, Everyday Household Spending, the first pillar.
Okay, to make sense of that massive economic web, we need to break it down into 4 distinct pillars. And we're starting with the foundational building block. This is the one you and I know best, the individual everyday level.
Introducing Pillar 1, Private Final Consumption Expenditure, or as we economists lovingly call it, the letter C.
We are proudly planting the very first piece of our final equation right here.
C represents the millions of daily choices made by households. It's literally the lifeblood of the domestic economy.
Economist B, notice how C is categorized. It includes non-durable goods, stuff you use up immediately, like buying lunch or groceries. Right. And it also includes durable goods that stick around for a while. Think about buying a new car, a computer, or even a washing machine. Oh, and finally, C covers services. Taking the bus, going to the doctor, or catching a movie. All of that counts as private consumption.
So, that makes sense for us, but wait. What about businesses? Where exactly does corporate spending fit into all of this?
Hitting the nail on the head. That is the perfect pivot. Households aren't the only ones opening their wallets. Businesses spend a staggering amount of money, but they do it for totally different reasons than you or I do.
Which brings us to Section 3, Business Investment Expenditure, the second pillar.
So while households consume, businesses invest. This pillar tracks how companies spend money to keep the engines of production actually running and growing. Let's lock in the second critical building block of our formula. We call this Gross Domestic Private Investment Expenditure. And for our equation, it gets the letter I. I represents all the cash private businesses spend on replacements, renewals, and entirely new investments. Simply put, without I, the economy would completely stagnate because nothing new would get built to replace the old.
Think of it like this. Factories, machinery, equipment, they're basically the seeds of future growth.
Great metaphor.
Businesses are constantly pouring money into new factory expansions or upgrading old tech. That spending, that investment expenditure, is the seed that ultimately grows into future production and future jobs.
Okay, fair enough. We have households buying food and businesses buying machines. But I've got another question for you. Who pays for the actual roads those business trucks drive on? Or the defense forces protecting our borders?
Exactly. Private citizens and businesses alone absolutely do not cover the nation's total expenses. There is a much larger player at the table that we have to account for.
Welcome to Section 4, Government and Global Trade, the Macro Pillars.
Now we're zooming way out to the true macro pillars, moving from individual families to the actions of the sovereign state and the international market. Meet our third pillar, government expenditure, represented by the letter G. G is split into 2 main areas. First, you've got final consumption expenditure on administrative services. This covers law and order, defense, public health, and public education. Second, the government spends massively on infrastructural facilities. We're talking roads, railways, bridges, dams. And let's be real, the entire business sector relies completely on this infrastructure to actually produce and move their goods.
Economist B. And now for the international angle, our fourth pillar, net exports, written as X minus M. X is the total value of our exports, and M is the value of our imports.
Right. We have to balance what we sell abroad against what we buy from abroad to find our net foreign investment. If we just counted everything bought in our country, we'd accidentally count imported goods produced somewhere else, and we only want to measure our domestic national income.
Okay, we made it to the climax of the explainer, Section 5, the final equation, pulling it all together.
We built our 4 distinct pillars, and now we are ready to finally snap this whole puzzle together. Get ready because this is one of the most famous classic textbook formulas in all of macroeconomics. Behold! National income equals C plus I plus G plus X minus M. It is just incredibly satisfying to look at. Totally! National income is the sum of household consumption, plus business investment, plus government expenditure, plus our net exports. Every single time money is spent on a final good or service in a given year, it naturally falls into one of these 4 buckets.
All right, let's dial the energy back just a touch for our final section. Section 6, Crucial Measurement Precautions. Correctly counting an entire nation's money is basically fraught with traps. If we just blindly added up every single transaction, we'd end up with chaotic errors and massively overstated wealth.
So let's rapid fire through these strict rules. Rule 1. Ignore intermediate goods. If a baker buys flour to make bread, we only count the final bread sale. Actually, scratch that. If we counted both, we'd be double counting the flour.
Right. Rule 2. Ignore secondhand goods. Buying a used car doesn't count because it was already counted in the year it was originally produced. We only care about current production.
Rule 3. Ignore transfer payments like pensions, scholarships, or unemployment allowances. This is just the government shifting money around. No new goods or services were actually produced in exchange for it.
Let's finish up the list. We must exclude the purchase of financial assets, like shares and bonds, because, again, they don't add to the real flow of actual goods and services.
We also have to deduct indirect taxes and include subsidies to get a truly accurate picture of actual value.
Honestly, tracking all this perfectly without double counting is incredibly difficult. Because of all these practical hurdles, the pure expenditure method is rarely used all by itself. Most countries rely on a mix of output and income methods to get the full picture.
Which brings us to our final, provocative question. We started this explainer by saying one person's spending is another person's income.
So think about your own wallet for a second. If there were a sudden drop in your personal consumption, if everyone's C's suddenly shrank, how do you think that would ripple through business investments, government tax revenues, and the rest of this interconnected national equation? It is a fascinating thought experiment to leave you with. Thanks for joining us as we explore the expenditure method. Keep tracking those receipts.